Hello, Internet friend. Today on Value Side, it's a tale of excessive leverage, how a gambling empire was lost. I'm David Ravel. Well, let's take a journey of our imagination. Imagine that you are a young, successful real estate developer, and based on your family's assets, you can borrow almost an unlimited amount of money from your banks. At just the time that you've settled into leading this real estate empire, a remarkable opportunity comes your way. Atlantic City, New Jersey is poised to become the gambling capital of America, and one of the prime casinos is available for purchase. You don't hesitate. As fast as you can, you contact the banks, explain the opportunity, and purchase the property. Lady Luck is shining on you. But the story gets better. Three more casinos become available, and even a gambling riverboat over on the Ohio River comes your way. You buy them all. Suddenly, you're one of the premier raconteurs in the nation, with a portfolio of gaming casinos that's the envy of everyone. Lady Luck indeed. But Lady Luck is a fickle creature and can turn in an instant. All of that borrowing with financial markets call leverage, or investment gurus call OPM, other people's money, requires a steady, unrelenting monthly payment. And when the interest rates is too high, in some cases as high as 14%, you can find yourself in deep trouble quickly. By now, you've no doubt figured out that our imaginary real estate developer is none other than our current president, Donald J. Trump. Those made up casinos are the Trump Plaza Hotel and Casino, the Trump Taj Mahal, and the Trump Marina. He also managed three other smaller casinos in Atlantic City and Gary, Indiana, and out in California. Now, looking back, this was an incredible portfolio of gaming properties and showed Trump to be one of the nation's premier casino developers. But his strategy had one overwhelming flaw: that financial leverage. As we've indicated, Trump had overextended. He acquired too much OPM. He had borrowed to the hilt, and when times turned tough, he could not make his monthly payments. High interest rates didn't help either. That 14% was a real number. It's the story of almost all of our financial crashes. We overextend by investing more than we can afford, and then, when times turn, we can no longer make the payments, just like Trump. From the 1929 stock market crash to the 1970s go-go bust to the dot-com debacle of the early 2000s, the great financial crisis of 2008, they've all been examples of excessive leverage leading to a financial correction, which we often call a crash. So when you realize that what Trump exposes goes far beyond his personal financial profile, and in reality is characteristic of modern American financial history, you realize we've got a problem. It's an obvious observation made at a time of record debt and financial leverage, when most observers think the Federal Reserve will raise interest rates at its next meeting. All the attributes that sank Trump and his gambling interests back in the 1980s. It's at this point, however, that I believe most financial prognosticators get it wrong. If you'll notice, most commentators and investment professionals are currently calling for inflation to be the next phase in the economic cycle. My objective is not to make a financial prediction here, but I believe there's an equal likelihood that runaway hyperinflation may not be in our future. Quite the opposite. We may well be looking at a graver, more dangerous phenomena, deflation, or more directly, what economists label debt deflation. Let's go back to that Donald Trump casino example. The question is, did the assets used as collateral for his many loans rise or fall in price after he left? The answer is they fell in price, some of them literally as they were later torn down. But the point is that his underlying debt propped up the value of Trump's properties. When the debt fell, so did the values. At the end of the day, Trump investors lost the money they had invested and were poorer. The banks lost the value of their loans and showed earnings and asset losses. Trump lost, and I believe had to declare bankruptcy. Overall, the financial systems declined to the extent of these collective losses. It's deflation, not inflation. The same sort of financial and asset decline we've seen in all of those mentioned financial crises. Clearly, Donald Trump's casino crash was not enough to cause the nationwide recession that we saw in the 90s and early 2000s. But many other investors, developers, and financial institutions were also overleveraged and also fell into financial distress when the economy turned down and interest rates rose. I believe that we're here again, overleveraged, borrowed to the hilt, with a likelihood of rising interest rates and the ever present possibility of a declining economy. There remains one way to avoid the real collapse. It's the one thing that every bank, lending institution, and ultimately, if it comes to this, bankruptcy court will ask. Do you have a plan to get out of debt? They will all judge your sincerity if you show a willingness to cut back on spending, to deal fairly and honestly with your lenders, and to point out ways you may improve your income. Lenders and ultimately judges want to know that you're reformed of these tactics and strategies that caused you to make late payments or defaults. As a nation, we are not subject to the legal constraints of a bankruptcy judge. However, we do have lenders. They're called bond investors. And these investors represent everyone from ordinary Americans to major financial institutions to global sovereign investment funds. Every day, the bond investors record their relative judgment on the merits of lending to the United States. While they don't have the option of requesting a special report on America's plan to reduce debt, they can show their relative assessment of America's financial posture by raising the coupon rate they require to invest. The week before Trump began the war with Iran, the 10-year U.S. Treasury note was priced to yield just under 4%, the lowest interest rate investors have seen in over a year and a half. This week, those same treasuries are priced to yield just over 4.6%. That's a 60 basis point rise in the 5 months of the war. Bond investors are speaking, and they don't like what they see. For President Trump, this may all seem like deja vu all over again, lenders becoming increasingly unhappy with his financial plan. It indicates a lack of faith in the president's direction for the country. Let's hope and pray that this does not end the way Trump's casinos did. Now, here are your economic benchmarks for the week. Economic growth. The third and final estimate of Q1 GDP came in at 2.1%. The preliminary estimate for Q2 GDP will be released on July 30. However, the unofficial but often revealing GDP Now, a running tab on GDP, currently estimates that Q2 GDP is running at only half of the Q1 level. They have GDP growth rate now down to a 1.3% rate, extremely low. Let's look at inflation. The Bureau of Economic Statistics released its latest inflation finding on Tuesday. It showed that inflation slowed to just 3.5% in June. That's down 0.7% from May. The reduction due almost entirely to a drop in energy prices, down 8% from the month before. It's a bonus from the brief cessation of hostilities with Iran. But as you know, the ceasefire is now over, so it will be interesting to see where inflation goes next month. Employment. The unemployment rate declined to 4.2%, down a tick from the month before. However, this number does not reflect the substantial loss in overall labor force. In recent months, 720,000 workers have left the workforce, bringing the total to only 169 million people working. That's a little above 59% of the population. There's a major demographic shift occurring here in our economic levels. Balance of trade. Last week, we reported that our trade deficit expanded to 77 billion, the lowest level in a year. This decline in trade numbers was due principally to the rise in oil prices and increasing domestic demand for pharmaceuticals. And that's ValueSide for today. For all of our articles and podcasts, visit valueside.com. I'm David Ravel. ValueSide is independently written and researched. The views expressed are strictly my own.